Preparing for a financial analyst at Mondelez interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Mondelez? I'm attracted to Mondelez because it combines globally recognized brands with a complex, data-rich operating environment. Products such as Oreo, Cadbury, and Ritz face different pricing, volume, currency, and channel dynamics, which would make the analysis commercially meaningful. I want a role where finance partners with marketing, sales, and operations rather than simply reporting results. Mondelez would let me develop strong FP&A skills while helping leaders understand performance and make better resource allocation decisions. While answering, focus on Mondelez's global snacking portfolio, analytical exposure, consumer-driven business model, interest in translating financial data into decisions, and alignment with the company's growth and productivity priorities. Question 2. What does a financial analyst do in a consumer packaged goods company? A financial analyst converts operating activity into useful financial insight. In a consumer packaged goods company, that means building forecasts, analyzing sales and margin variances, monitoring promotional effectiveness, and partnering with commercial and supply chain teams. I would investigate whether performance changed because of price, volume, mix, currency, input costs, or execution. The role is not just producing reports, it is explaining what happened, identifying likely outcomes, and recommending actions that improve profitable growth. Make sure to cover budgeting, forecasting, variance analysis, management reporting, business partnering, profitability analysis, data quality, and how finance supports commercial, supply chain, and strategic decisions. Question 3. How would you analyze Mondelez's revenue performance for a quarter? I would begin by reconciling reported revenue to the prior year period, then separate organic growth from currency translation, acquisitions, and divestitures. Within organic growth, I would decompose performance into price, volume, and mix across regions, categories, brands, and channels. I would investigate whether pricing offset volume pressure, whether premium products improved mix, and whether promotions shifted timing. Finally, I would compare results with budget, prior forecasts, and market trends before explaining the key drivers and outlook. In your answer, talk about reported and organic growth, price, volume, mix, geographic performance, brand and category trends, foreign exchange, acquisitions, promotions, and reconciliation to management reporting. Question 4. How would you build a sales forecast for a Mondelez brand? I would build the forecast from a validated baseline using historical sales, seasonality, distribution, pricing, promotions, and recent demand trends. Then I would incorporate known customer plans, new products, advertising support, and category growth assumptions. I would challenge inputs with sales and marketing rather than accepting them mechanically. Finally, I would create base, upside, and downside scenarios, identify the largest sensitivities, and update the forecast as actual sell-through and retailer data become available. Be sure to mention historical trends, baseline demand, seasonality, price and promotion assumptions, distribution, customer plans, market data, risks, scenarios, and collaboration with sales and marketing. Question 5. Explain the difference between gross margin and operating margin. Gross margin is revenue less cost of goods sold, divided by revenue, so it reflects product economics and manufacturing costs. Operating margin subtracts operating expenses such as marketing, selling, research, and administration as well. For Mondelez, gross margin could decline because cocoa costs rise, while operating margin could also be affected by higher advertising investment or restructuring. I would analyze both because gross margin explains product profitability, whereas operating margin shows broader business performance and cost discipline. While answering, define both measures, explain cost classifications, connect margin changes to pricing, volume, mix, commodities, manufacturing, marketing, overhead, and clarify why operating margin provides a broader profitability view. Question 6. If revenue increases but profit declines, how would you investigate? I would bridge revenue to operating profit and isolate each driver rather than assuming growth was beneficial. I would test whether lower margin products or customers drove the increase, whether promotions diluted pricing, and whether commodities, freight, labor, or currency raised costs. I would also review incremental marketing, overhead, restructuring, and one-time expenses. the conclusion might be that revenue grew through volume but mix deteriorated and input inflation exceeded pricing, creating a clear need for corrective action. In your answer, talk about price volume mix, input costs, promotional spending, freight, foreign exchange, customer or product mix, operating expenses, one-time items, and reconciliation from revenue to operating income. Question 7. How do price, volume, and mix affect Mondelez's results? Price measures the revenue effect from changing selling prices, volume captures units or consumption changes, and mix reflects the relative contribution of products, markets, or channels. A price increase may lift revenue but reduce volume, while premium products can improve both revenue quality and margin. I would quantify each effect using a bridge and examine interactions carefully. At Mondelez, mix could improve through premium chocolate growth but weaken if lower margin promotional packs gain share. Make sure to cover the definitions, revenue and margin effects, interaction between pricing and demand, premiumization, product and channel mix, promotional intensity, and the importance of separating drivers in variance analysis. Question 8. What is working capital and why is it important for Mondelez? Working capital represents the cash tied up in operating assets and liabilities, primarily receivables, inventory, and payables. For Mondelez, inventory planning is especially important because it must balance product availability, freshness, seasonal demand, and manufacturing efficiency. I would monitor days sales outstanding, inventory days, payable days, and cash conversion trends. Improving working capital releases cash, but excessive inventory reductions could create stockouts or service problems, so the target must support profitable growth. Be sure to mention receivables, inventory, payables, cash conversion, retailer terms, production planning, stock availability, supplier relationships, seasonality, and the trade-off between liquidity and service levels. Question 9. How would you evaluate whether a promotion was financially successful? I would compare promoted sales with a realistic non-promoted baseline, then calculate incremental volume and net revenue after discounts, trade spending, and allowances. I would assess contribution margin rather than simply gross sales and test for cannibalization among related products or pull forward from future periods. I would also review retailer inventory and post-promotion demand. A promotion is successful when incremental profit, strategic distribution, or consumer recruitment justifies the investment, not merely when shipments increase. While answering, focus on incremental volume, net price, trade spending, cannibalization, retailer inventory, baseline demand, contribution margin, post-promotion effects, and comparison with the original commercial objective. Question 10. How would foreign exchange affect Mondelez's financial results? Foreign exchange affects Mondelez through transaction exposure on foreign currency purchases or sales and translation exposure when local results are converted into the reporting currency. A weaker local currency can reduce reported revenue and profit even if local performance is stable. I would separate reported from constant currency results, quantify the impact by market, and consider pricing or hedging actions. I would not confuse translation effects with operational weakness, but I would still assess their cash and planning implications. In your answer, explain transaction and translation exposure, reported versus constant currency growth, geographic earnings, hedging, local pricing responses, and the distinction between accounting impact and underlying operating performance. Question 11. What is a budget variance and how would you present one to management? A budget variance is the difference between actual performance and the approved plan, expressed in dollars, percentages, or operational drivers. I would identify the largest variances, separate timing from structural changes, and explain the root causes using price, volume, mix, costs, and spending. My presentation would start with the headline, quantify the impact, and state the action required. I would then update the forecast if the variance changes the expected full-year outcome. Make sure to cover favorable and unfavorable variances, materiality, driver-based explanations, timing versus permanent differences, corrective actions, visuals, concise messaging, and implications for the full-year forecast. Question 12. Describe a time you found an error in financial data. In a reporting project, I noticed that one region's margin improved sharply despite stable pricing and rising costs. I reconciled the source data to the general ledger and found that a freight expense file had been loaded twice in the prior month, distorting the comparison. I confirmed the issue with the accounting team, corrected the report, documented the root cause, and added a validation check comparing uploaded totals with ledger balances. That improved both accuracy and confidence in the process. Be sure to mention the control or analytical review that identified the issue, validation steps, root cause analysis, communication, correction, documentation, and preventive control implemented afterward. Question 13. How would you assess the profitability of a new Mondelez product? I would model expected volume by channel and market, net selling price, trade investment, variable manufacturing cost, packaging, freight, and incremental marketing. I would calculate contribution margin and then include fixed launch costs, working capital, and any expected cannibalization of existing products. I would build sensitivity cases around distribution, repeat purchase, commodity prices, and promotional support. The recommendation would consider strategic benefits, but I would clearly distinguish attractive revenue potential from sustainable incremental profit. In your answer, talk about volume assumptions, pricing, trade promotion, manufacturing costs, packaging, distribution, marketing investment, cannibalization, working capital, contribution margin, and scenario analysis. Question 14. What financial metrics would you monitor for a Mondelez business unit? I would monitor organic net revenue growth, volume, price, mix, market share, gross margin, operating margin, and cash flow. For a consumer business, I would also track promotional efficiency, distribution, inventory, trade spending, and forecast accuracy. Each metric needs context. Revenue growth may be price-led, margin may reflect commodities, and market share may come at excessive promotional cost. I would combine financial and operational indicators so management sees both current performance and the drivers behind it. While answering, focus on net revenue growth, organic growth, volume, price, mix, gross and operating margin, market share, trade spending, cash flow, working capital, and forecast accuracy. Question 15. How would rising cocoa or other commodity costs affect your forecast? I would quantify the exposure by commodity, product, region, and expected consumption, then map the timing of contracts and hedges. I would model the impact on cost of goods sold and margin under multiple price scenarios. Mitigation could include pricing, productivity, pack architecture, premium mix, sourcing, or promotional changes, recognizing that each may affect demand. I would communicate the unmitigated and mitigated outcomes clearly, so management can distinguish a risk from the actions available. Be sure to mention cost exposure, timing, hedging, supplier contracts, pricing, productivity, pack or mix changes, margin sensitivity, scenario modeling, and communication of risks to commercial stakeholders. Question 16. What is the difference between cash flow and profit? Profit is measured under accrual accounting, while cash flow reflects when cash actually enters or leaves the business. A sale can increase profit before the customer pays, and depreciation reduces profit without a current cash outflow. Inventory purchases, receivables, payables, capital expenditures, taxes, and interest also create differences. I would reconcile operating profit to operating cash flow, then subtract capital expenditures to assess free cash flow. This matters because growth can consume cash through inventory and receivables. In your answer, explain accrual accounting, non-cash items, working capital movements, capital expenditures, timing differences, free cash flow, and why profitable growth does not automatically equal strong cash generation. Question 17. How would you prioritize competing requests from sales, marketing, and operations? I would first clarify the decision each request supports, its deadline, financial materiality, and dependency on other work. A forecast input needed for an executive review would typically take priority over a lower-impact ad hoc analysis. I would communicate trade-offs early, provide realistic delivery times, and use a standardized template where possible. If priorities conflict, I would escalate with facts rather than guess. Throughout, I would protect data quality because a fast but unreliable answer can create larger downstream problems. Make sure to cover business impact, deadlines, materiality, decision usefulness, dependencies, stakeholder alignment, transparent trade-offs, escalation, and maintaining accuracy under pressure. Question 18. How would you use Excel to analyze a monthly performance report? I would first validate the source data, standardize dimensions, and reconcile totals to the ledger or approved report. Then I would use pivot tables, SUMIFs, XLOOKUP, and structured calculations to analyze results by brand, market, customer, and period. I would build variance bridges and scenario inputs while adding control checks for duplicates, missing values, and total agreement. Finally, I would summarize the few drivers that matter most, rather than overwhelming stakeholders with an unfiltered spreadsheet. In your answer, mention data cleaning, reconciliations, pivot tables, formulas, variance bridges, checks, scenario analysis, automation, documentation, and presenting insights rather than merely displaying calculations. Question 19. Tell me about a time you explained a complex financial issue to a non-finance colleague. I once explained an unfavorable margin variance to a commercial colleague who initially viewed it as an accounting issue. I translated the result into 3 operational drivers: heavier discounting, lower premium product mix, and higher freight cost. I used a simple waterfall chart, avoided technical terminology, and showed how changing the promotion plan could recover part of the gap. The colleague understood the trade-off and adjusted the plan. That experience reinforced that finance creates value when insight leads to action. Be sure to mention simplifying technical language, using operational drivers, tailoring the message to the audience, confirming understanding, recommending action, and demonstrating collaboration rather than merely presenting numbers. Question 20. What would you do if your forecast differed significantly from a senior manager's expectation? I would first recheck the data, formulas, timing, and assumptions to ensure the difference was not an error. Then I would meet with the manager to understand any commercial information not reflected in my model, such as customer commitments or planned promotions. I would present the bridge objectively, show base, upside, and downside cases, and identify the assumptions creating the gap. If disagreement remained, I would document the risk and align on the forecast adopted and its monitoring triggers. While answering, focus on validating assumptions, checking data, understanding the manager's perspective, presenting evidence respectfully, using scenarios, documenting risks, and supporting a fact-based decision without becoming confrontational. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.